Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. We already understand the three types of questions that we aim to answer with corporate finance, and that is how to invest, how to raise money to invest, and how to give back money to shareholders. So by now, you should be very good at understanding what corporate finance is all about. But let's make it real. The application process, it's usually going to be in firm valuation. So in today's episode, I'm going to give you 3 methods for valuing firms, and we're going to follow step through step all of the things that you have to know for doing a firm valuation. I had done a previous episode regarding firm valuation where I explained DCFs, but today we'll combine other methods. So if you feel lost, I'll leave the link to my DCF episode in the description so you can check that one out in case you don't know all the concepts. Now, let's start with important things. What are you really valuing? And why am I asking this? Many people are messing this up because you may want to find the total enterprise value or just the equity value. The enterprise value will usually include also debt, which is an important part. If you remember our accounting statements, we usually have assets on the one hand and then debt and equity on the other hand. So if we want to value the entire firm, we do need debt plus equity. If you only want the equity value, which is the one that's related to the stock market, then this is going to be different and you need to subtract debt from that value. And second important concept, it's going to be that valuing is different from pricing. And this is usually what all of the finance analysts are trying to know, and it's if there is a gap between the price and the intrinsic value of a stock or of a company. And we should aim to close this gap by knowing at least the intrinsic value. Pricing is going to be based usually on market behaviors and supply and demand, while valuations are going to be based on the cash flows, on the growth, and on the quality of the growth that the firm is presenting. So don't confuse this two and actually have it present that maybe there is this gap, and that is the thing that we want to achieve by doing this valuation. Now, let's start diving into the 3 methods, and as I was telling you at the beginning of the episode, we're going to start with the method that I already explained, and it's called the DCF method, or discounted cash flow methods. I'm going to be running through this one faster than I did in my previous episode, but with this one, basically you'll just get 5 steps. The first one is getting the free cash flows of the firm. And for getting the free cash flows of the firm, basically you just need to have the EBIT and multiply that times 1 minus the tax rate. After you have that value, we're going to add back depreciation, and then we're going to subtract the CapEx and the change in net working capital. So the CapEx, if you're wondering, is going to be the change in the property, plant, and equipment. So all of this are going to be the fixed assets between periods. So you'll take the future minus the previous one, the current one. And then it will also include depreciation. So I'll be sharing all of those formulas while I'm talking so you can see them, and this doesn't sound very weird. But CapEx, briefly said, is just the change in property, plant, and equipment plus the current depreciation. Now, net working capital is going to be the difference between current assets and current liabilities. But if we want to break it down even more, it would be having the operating cash plus accounts receivables plus inventory, and then all of this minus accounts payables and accrued expenses. This is going to give you net working capital of one period. And what you need for the free cash flows of the firm is getting the difference between periods. So if you have all of these parts, you would already have your free cash flows of the firm. Second step would be estimating the WACC. So this one will have kind of two steps. One of them is estimating the cost of equity, which I talked about in my previous episode. It will have an equation that's specific for cost of equity where you have market risk premium and other stuff. But then for the WACC, you also need cost of debt because the WACC is going to account for all of the firm value, not only the equity part. So you're going to take the equation for doing debt and equity, and the WACC will give you the cost of capital of the entire firm. Third step would be discounting the cash flows with the WACC, which means bringing all of these values that you already know up to present value. Be careful over here because the fourth step may or may not apply, would be also including the perpetuities of the future growth. So if you feel kind of lost, remember that perpetuities are going to mean when you set up a firm to grow forever, usually at a specific rate of 2%, 1%, some percent that's going to be used as a perpetual growth, you also have to discount this value and bring it back to your present value. Lastly, once you have the discounted cash flows of the firm and the discounted perpetuity, you're going to estimate the equity value by taking the amount that you got, summing up all of those present values, and just subtracting the debt. So this is a very fast overview of what the DCF method would be. Then a second method that would be recommended, and usually you would be encouraged to do both just to make sure that none of them are off. They may give you different numbers, and this doesn't matter. It's just all of the valuation methods are going to be a proxy for what the intrinsic value is. So the more options that you have for setting up those boundaries, the better is going to be your forecast. So the second method is going to be for multiples. And multiples valuation, I also mentioned it before, but over here I'm going to explain the details on how we would calculate it, but we would only have 4 steps for doing this one. It's a little bit easier. First step would be to identify comparable firms. And for this one, this is the key step that we're going to need for this method to be successful, because all of these comparable firms should have similar industry, similar financial statements a little bit, and then similar products. And even though this sounds easy, it's not going to be as easy to find in real life. Second, you're going to identify all of the valuation ratios that you're going to need. You can find either enterprise valuation ratios or equity valuation ratios. So we'll go back to the first thing that I was explaining. Either you want the total value of the firm or just the equity value of the firm. And this is kind of putting apples with apples and pineapples with pineapples or whatever other fruit that you want. Because for enterprise valuation, we'll take up the entire value of the firm. So that is adding equity and debt. And then we're going to divide this by a value that we know, such as the EBIT, the free cash flows, the EBITDA. So these are all going to be different ratios, but be sure to take equity plus debt. Debt is usually going to be disclosed. You should take the long-term value of debt. And for the equity, my recommendation is to never use book value of equity, because this value may be weird or may be manipulated by share repurchases. You should always use the market value of equity, which means the market cap. So take market cap plus debt and then divide it by whichever value that you want. So EBITDA, EBIT, or free cash flows. Here you have to make sure that the companies that you'll compare to are going to be in a similar location. And this is going to be related to taxes, because if I'm comparing a firm from Colombia to a firm from US, we're going to have very different tax rates, and this may affect your comparison. So make sure, an important point is having firms that are in your similar location. Also, but this was obvious, make sure that it has similar capital intensity, similar risks, and similar growth in earnings. Now, if we're going to do ratios that are for equity valuation, we should take the equity value divided net income. And this is commonly known as the PE ratio. So for the equity value, we can use the market cap or the price that you currently have for the firm, and we're going to divide it by the net income. For this ratio, you also have to make sure that your comparable firms will have similar capital intensity, similar risk, and the similar growth in earnings that we were aiming in the first step. Then, third step would be, now that you decided which are your comparable firms and which ratios you're going to analyze, would be just identify the enterprise valuation ratios and equity valuation ratios and calculate them for your peers. And the fourth and final step would be applying those multiples into your firm, having either equity value or total company value as the value that you need to find. So if we were doing simple arithmetic things, it would be taking the average or the median of the competitors' ratios, then taking your firm's numbers, plugging the numbers, and multiplying them in order to get the equity value. If you wanted the total value, then you can get the equity value and then add debt to it, and this is going to make it better. So now, after these two methods, usually recommended, we're going to already know what a firm is going to be worth. But we may have a third and final method, and this one is completely new. I hadn't talked about this one before, and it's called the adjusted present value method. And this method is going to separate the debt from the firm value, and it's going to be a flexible model in case that the debt to equity ratio is going to be constantly changing within the firm. So I don't advise doing methods 1, 2, 3. That would be very long. 2, you should always do, but then you can decide if you do 3 or if you do 2 based on the flexibility needs that you have for the firm. If you know the firm is going to be changing its debt to equity ratio, then it might be better to do APV method or adjusted present value. But this one has a caveat, and is that you need to know the estimate of the debt in dollar value, at least for the future periods, and ideally also for perpetuity. So this one will have a small caveat, but it will give you more flexibility because you can adjust it for different levels of debt, always in US dollars value or the currency value. So this one will have a little bit more steps. It's going to have 6 steps, but most of them are recycled steps from the DCF. So first one would be getting the free cash flows of the firm. We already know how to do that. Second one would be finding the cost of equity if the firm was unlevered. And this one is going to be represented by RU. And the equation, I'm going to share it while I'm talking, it's having the risk-free ratio plus the beta if the firm was unlevered times the market risk premium. And so how do we get the beta if the firm was unlevered? Taking the normal beta and then multiplying that by equity divided debt plus equity. Then, third step would be discounting the free cash flows, but with RU, so be careful, never use the WACC that you used in the DCF, always use RU. And then, now that you have that, you'll have basically the value of U. It's going to be the value of the firm if the firm was unlevered. Then fourth step would be estimating the debt repayments each year. So this is the crucial part that I was telling you you'll need to know from the initial debt that the company has, how much it's going to pay every period, and you're going to have to subtract those repayments every year to get the final dollar amount that you'll have. Or if the firm isn't planning on paying back its debt, then you need to know what is going to be the amount of debt in dollars. Fifth step would be getting the debt tax shields, or also commonly known as the DTS, and you're going to discount the debt tax shields with the cost of capital. So the tax shields are going to be basically the debt of the previous year times the cost of capital times the tax rate, because if you remember well, debt is going to give us a tax relief. So we have to calculate how much we're going to get from that, and it will be through this equation, debt from the previous year times RD times the tax rate. This is going to give you the DTS, debt tax shield. And then, of course, you have to discount those with your cost of capital, so cost of debt ratio. Now that you have that, you're going to have the present value of the debt tax shields, which was discounted by cost of debt, and your value of the unlevered firm, which was discounted using your RU. Basically, you just have to sum this two up and subtract or add any other debt effects that you may have, and this will give you the entire value of the firm. So this is a bit of a longer process because you're doing the valuation of the firm on the one hand and then separately doing the valuation of the debt and what is this going to bring you as a value. So it may be longer, but it's going to be very good when you need this flexibility. So remember, APP will give you a pro that is going to be more flexible when you have complicated leverage versus DCF that is going to be more useful for constant D to E ratio. The multiples method is very fast, so this one I would suggest doing it even regardless of your decision between DCFs or APVs. Lastly, I want to finish up this episode by telling you that there are 4 ways of optimizing firm value. The first one is going to be increasing your cash flows. The second one is going to be reducing your cost of capital. The third one would be increasing the expected growth. And the fourth one would be by making your growth longer. If you want to learn more about this, make sure to check out all of my notes on LinkedIn, and I'll leave my link in the description. On my next episode, we'll be talking about mergers and acquisitions, which is going to be a place where we'll apply all of this valuation and all of the 3 corporate financing decisions, plus a little bit more. I'll see you next week.